Good afternoon. So we start today's session on taxation, GST and duty drawback in gem and jewelry industry. So for this same session, I welcome Mr. Siddharth Surana, who is the director of RSM India, and also I welcome Mr. Ritesh Negandhi, who is the associate director of GST of RSM India. So before we go to introduce the speakers, I would like to just give a brief background that what we'll be doing today. As you all know that the Gem and Jewelry Export Promotion Council in the gem and jewelry sector is working for its more than 7,500 members to see to it that the GST implementation across the trade is smooth, and we have been successful in the same through the past few years to an extent. Of course, RSM is a big friend into that, how to see from the time GST was announced to be implemented, from that time we are working with them. So in this process, why we are here today is to explain that how the duty drawback, there are so many things which is being announced by the government, but for exports, we have seen that in our sectors, especially in our sector, when you go to any other sector, if you across, you will see that all are taking the benefits for the exports in terms of different schemes which are being announced by the government, absolutely to the T. Every benefit what is given by the government is taken by them, and if suppose some benefit are withdrawn or some benefit is tweaked, instantly they go to the government that this is tweaked, so our export will be costly, etc. But unfortunately, in our sector, we have seen that it is very less people are taking this benefit. So this is a sensitization measure where we are trying to sensitize our industry. All of you who are here, all of you are exporters, I understand, and our members. So, or if you are not exporting, you should understand that how you can take those benefits. What are those benefits? The benefits come in the form of duty drawback. That means whatever you export and whatever duties you have paid, import duties and etc., that you can take back from the government by claiming that. How to claim that they will explain. You have an RODTEP in way of exports, unseen taxes, let's say some cess, some electricity duty, etc. All these taxes, whatever you have suffered. So based on that, this council has gone to the members, and based on their submission, we understand that how much per unit value of exports, how much taxes has suffered in way of exports, that you can take back. So you can claim back. That is called RODTEP, and that how to claim back again, they will tell you. The EPCG, of course, there is a long debate going on whether EPCG will continue or not. But for you who are manufacturer exporters, the machines what you bring in for exports, and helping you to increase your efficiency, the technological imports, etc. For that, EPCG can be a big benefit where you get the duty benefit. Against that, you have to give some sort of guarantee of some exports. So that also they will explain. So it is not that with the machines you will only process the exportable goods, but you can also process your local sales also, but you have to only give a commitment to a certain amount of exports. So deemed exports benefits. So advanced authorization is another thing. Like suppose it's a deemed export, you are supplying something to Siebes or etc., which ultimately will get export. How you will get the advanced authorization benefit, that also they will be explaining. Or you special economic zones, export incentives relevant to gem and jewelry exporters. After this budget, how it has come, that also they'll be explaining today. So it will be a hugely informative session for you. Not only informative, using this, you can increase your surplus or profits, whatever it is, or you can also lessen the cost of raw material. So your exports will be more competitive. That is what why we are here, all of us are here. And after that, of course, you can also ask the speakers also different questions, how you can get the benefit. You have a lot of companies can have specific queries, that also you can ask. So this is where we are. So I'll just give you a brief about RSM. Of course, RSM India is not new to our sector. All of us know that what they are doing, but right now they are, RSM International over 51,000 manpower they are having at 123 countries with annual combined income of 7.26 billion, which is a huge company itself. So you can understand. And in India, it has a nationwide presence through offices across 11 cities and a multidisciplinary team of 2,100 professionals. It is a, the profile is absolutely attractive and of course astounding. So of that, Mr. Siddharth Surana, who is the director of RSM India, Mr. Siddharth Surana is a director who is, as part of his tenure with RSM India, he has supervised several consultancy projects with a myriad of clients across various sectors. So I have different cross-sectoral experience also. And he has a specific, experience in gem and jewelry sector. And also he has a domain expert of indirect taxes and policy measures of various industries. So, Mr. Siddharth, if you give a background, he is a PGDM, that's postgraduate diploma in management from the prestigious Indian Institute of Management, Bangalore, and a triple rank holder in the Chartered Accountancy examination. And Mr. Ritesh Negandhi, who is the Associate Director of Indirect Taxation, RSM India. So, Mr. Ritesh Negandhi has over 15 years of experience in the indirect tax and customs domain. He has wide experience in all aspects of indirect taxes, including due diligences, policy representation, and etc. So, as a panel, what we understand, you have a very, well qualified panel to give you knowledge about this thing and also answer to your queries. So now, of course, I have given you the background. So let us hear from them, the panel who are there. So I would request Mr. Siddharth Surana and Mr. Ritesh Negandhi to take over from here. Thank you.
Thank you for the introduction and for this opportunity. I would like to extend my greetings to all the attendees of the webinar. So in this, the objective is to give an overview about the export incentives, because as we said that there are many schemes in this regard that are there. So the objective is to sensitize and to give an overview about these schemes. So we have put together a presentation, which I'll be sharing on the screen right now. I hope it's visible to all there. So just to give an overview or a context to set this webinar, in the recent budget, a lot of announcements were made regarding boosting exports. Because this is a part of the Make in India and Atmanirbhar initiatives, is to substitute imports and also to promote exports in a big way. And India's merchandise exports have really grown in a very big way. And as of the recent statistics, it has stood at 301 billion USD from April to December 2021. So in regard to this, export incentives play an important role in incentivizing the exports, and they are available in various forms. Like the drawback, there are script-based incentives where you get scripts based on the quantum of export achieved, and there are also duty exemptions that when you're importing products or even some local procurements, one can get duty exemptions when procuring these for the purpose of export. So the government is, one important thing that needs to be kept in mind is that as these export incentives are being introduced, they are being moved more and more to a WTO compliant manner. And the endeavor is also to make the claims of these exports incentives digital and easy. Many people hesitate from claiming these incentives because they feel that it requires a lot of procedures. So the government's endeavor is to try and do away with that and bring about a lot of simplification in the process and automation in the way the benefits are delivered. So for the gem and jewelry industry, which is constituting nearly 10% of India's merchandise exports. So as of April to December, according to our understanding, the exports were nearly 29 billion. And they have risen by nearly 76.4% in dollar terms, which is a very big increase, because if you consider the fact that the dollar is always pegged and it moves in a higher way than the rate, the actual growth could be close to 78-80% in rupee terms. So it's a remarkable amount of exports which are happening, and given the share of gems and jewelry in the exports, it's very important sector for us, and therefore the export incentives and benefits are even as vital because they affect the costing and profitability when we are dealing with the world at large. Although India right now is becoming a very major competitive hub for all the gems and jewelry exports and supplying all over the world, but it can become even more competitive if all the export incentives are claimed. Incidentally, when we understood the statistics, we found that the claim being made under the export incentives by the gems and jewelry sector are relatively low. Like, although we are contributing around 10% of the to the merchandise exports, but our claims are much lower than that. So there are various export incentives that are there, and it would be very difficult to cover all the schemes, but out of the many schemes which were there, which we found that were relevant to the gems and jewelry industry, they are export-oriented units. Then there is duty drawback under Section 74 and 75 of Customs Act. So basically, the duty drawback sections are different because one, Section 74 pertains to when I'm importing some goods and selling it as such. So it's import and re-export. And Section 75 is when I'm importing some materials which are used in manufacture of exported products. Then there is a remission of duties and taxes on exported products. So that's the RODTEP scheme, which is one of the most recent schemes which has come out. And it's the first scheme in the endeavor to be WTO compliant. Then there is special economic zones, which are created, and especially many in the gems and jewelry space, which are going to be useful for exports. There's also the Advanced Authorization and the EPCG scheme, which is more on the duty concession side, which was also relevant to the gems and jewelry industry. In the recent budget, there was an announcement made that the EPCG may be gradually phased out, but that is subject to discussion, and there would be certain exemptions in place if for machines which are not ordinarily available in India, and certain sector specific relaxations were given. But we'll touch upon that in the relevant slide when we come to that. So these are some of the export incentives. In addition to this, there are also other incentives like the GST refunds on the exports and other aspects, but those we haven't touched upon in the interest of time and other aspects. So so before we go on to the aspect of export incentives, it's important to understand the objective. So some of the export incentives, they enable the duty-free import of inputs for export production. So this enables us to not bear any costs or cascading effects when we are exporting certain products. It also gives rewards to exporters to offset infrastructural inefficiencies and hidden costs. So there are a lot of costs associated with transport, fuel, etc., where we are bearing a certain amount of taxes and costs. So this, the objective of some export incentives is to reward the exporters to offset these infrastructural inefficiencies and hidden costs. The major objective of why the exports are happening in the first place is that it is to give an economic boost in terms of employment and ease of doing business, and for earning foreign exchange and a favorable balance of payment situation. So these are all the objectives, and India has a very aggressive target to achieve a lot of economic growth, and exports are a key to that. So now coming to the specific schemes, the first scheme that I would be discussing about is the Advanced Authorization scheme. So first, it's just important to kind of understand what is an Advanced Authorization. So Advanced Authorization is two words, that is advance and authorization. It means I'm taking an authorization in advance to import goods duty-free. By holding an authorization, I'm entitled to take in goods in a duty-free manner. So going as per the legal definition, Advance Authorization is a scheme which will entitle the applicant to undertake the duty-free imports of inputs which are physically incorporated in the export product. So in the gems and jewelry context, so in case of a jewelry or which is a finished product, gold is one of the inputs which is physically incorporated in the product. So using this scheme, one can avail the benefit of the duty-free import of gold in case if they are exporting jewelry. And in addition to the inputs like gold, one can also take benefit of packaging material, fuel, oil, and catalyst, provided it is consumed and utilized in the process of production of an export product. So in addition to the gold, if I'm also using any packaging materials, fuel, oil, and catalyst, in the process of producing the export jewelry, which is intended for export, I can get benefit of duty-free imports on even those products. Given the intricacies of the gems and jewelry industry, within the advanced authorizations, there are several schemes, but there are specific schemes in place for the gems and jewelry sector. So coming to what imports are covered under the advanced authorization. So the first condition is that they are inputs which are physically incorporated in the export product. So it is subject to a pre-import condition, which also I will talk about later. And the inputs have to be used in the export product. Then there are packaging materials which are allowed, and then there is fuel and oil, and also catalysts, which are allowed to be covered under the advance authorization. So coming to whether only imports are covered, the answer is no. Sometimes even the local procurement, if it is against an advance remittance order, an ARO, advance receipt order, or an invalidation letter, in some cases, even from domestic players, we can acquire certain products under this scheme, and it is treated as a deemed export under GST. So in some cases, even the domestic is allowed, but you need to comply with certain conditions. What are the duties which are exempt under advance authorization? So for the gems and jewelry industry specifically, all the duties of customs which are specified in the Customs Tariff Act are eligible for duty-free imports. This includes the basic custom duty. It also includes additional custom duty, countervailing duty, safeguard duty, and anti-dumping duty. But IGST and compensation cess, which are already part of the GST regime, those are not covered under the advance authorization. So that is what I just wanted to cover about what were the duties covered under this. So so just to summarize, IGST and compensation cess, which is presently under GST, that benefit is still not there under the advance authorization. Now, the important thing to understand is who is eligible for this advance authorization in the first place. So this is an important aspect, that you have to be the actual user of the export or of the imports which are coming in, and you have to be the actual user. So there is a condition called the actual user condition, and the advance authorization can be issued either to a manufacturer or exporter. So suppose I'm manufacturing the goods and exporting by myself, then I can be taking the benefit of this duty-free import, because I am ultimately producing the final product which is being exported. Or if I don't have my own production facilities, then I can be taking an advance authorization in the nature of a merchant exporter by tying up with a supporting manufacturer. So as an example, suppose I'm a person who doesn't have, who only can do a little bit, packing and other things, but I can't do the manufacture on my own, then I can tie up with the help of a supporting manufacturer, and I can undertake the export. So I will get the orders and the shipments. That part will be handled by me, but all the manufacturing would be done by a particular person. One of the conditions for availing this benefit is that the exporter needs to have a past export performance for at least 2 preceding financial years. And advance authorization is also valid if I am supplying to an SEZ unit, which in turn is exporting the products, on the condition that I have realized a payment from the foreign currency account of the SEZ unit. So I can supply to an SEZ unit, but I have to ensure that I receive consideration from them from the foreign currency account. Now, what is my entitlement under the advance authorization? So entitlement is calculated in terms of a percentage of the CIF value of imports. So whatever imports I'm undertaking, I can get an entitlement based on a certain amount based on that import. But this import cannot be unlimited. Like it is restricted to the higher of 300% of my value of exports. And if I'm doing any deemed export, the rupee value of that, or 1 crore rupees. So my CIF value would be restricted to higher of 300% of the value of exports or 1 crore rupees. And my benefits would be calculated like based on the CIF value using the standard input output norms, which are notified by the DGFT. I'll be allowed to claim this. So if we find that the standard input output norms are not in our favor, then exporters can apply to the DGFT and make an application that according to us, this is the input output norm that should be in place if the standard input output norm does not suit them. So here I have just tried to summarize some of the important aspects of advance authorization. So it's based on the actual user condition. It's only eligible for notified imported goods where duty of customs is leviable, and this benefit is not available for the GST. Entitlement is on the CIF value of imports. Then the quantum of input which is allowed on which you can claim the benefit will be based on the standard input output norms, which considers the wastage. Then import are subject to pre-import condition. So we have to take this authorization before the import actually takes place. Like it has to be in place before, we cannot do it on post-facto basis. So suppose I obtained the authorization on 2nd of Feb, but the import already took place in the month of January, then I won't be eligible to claim any duty concession on that. And the one other important criteria is that the import or whatever local procurement I'm doing, that has to be physically incorporated in the product. And for gems and jewelry, there's a value addition that needs to be achieved by the exporter. So suppose I'm importing goods of say 100 crores, then I have to add a value on that 100 crores, and my export has to be greater than 100 plus the prescribed value addition. Then only I'll get the benefit of advance authorization. And this advance authorization is valid for 12 months from the date of authorization. Now, one other last important condition that needs to be met is that all my exports need to be realized in convertible foreign exchange and within the prescribed time limit, what is as per FEMA. So coming to the specific aspects, so since I mentioned that the standard input output norms consider wastage. So suppose I'm using any raw materials in my manufacture of jewelry, there is certain amount that goes waste in the production. So there are the percentages that have been prescribed for the different types of article based on the item of export. And the percentage of wastage which is allowed is with reference to the gold, silver, or platinum content in these export items. So in case of plain jewelry, articles and ornaments like Mangal Sutra, which are containing all the materials which are mentioned in the first line, I am allowed with respect to gold and platinum 2.5% wastage, and in silver 3.2%. For studded jewelry and articles, the percentage is same whether it's gold, platinum, or silver, which is 5%. In case of mountings and findings, which are manufactured without using a mechanized process and which are manufactured indigenously, I get an allowance of 2.5 wastage on the gold content or platinum content and 3.2% on the silver content. In case of the mounting which are used in studded jewelry, there's a 1.8% wastage allowance on the gold and silver and platinum used. And if I'm using jewelry which is manufactured, or if I'm exporting jewelry which is manufactured using a 100% mechanized process, or if I'm also using findings and mountings which are manufactured by a mechanized process, where it is 0.9%. And in case of medallions and coins, I'm allowed a 0.2% wastage with respect to the content of the metal in it. So as mentioned, there's also a value addition norm, which is specified for the gems and jewelry industry. So value addition is calculated as the difference between my value of my exports, which I have realized, less the CIF value of the inputs where I've taken benefit of authorization. And further, we will also reduce value of any input on which any drawback is claimed or intended to be claimed. So we'll be covering drawback also later. So that in case if I'm availing the benefit of drawback, my value addition will be subtracted to the extent of my drawback claims or to the value of the drawback. So the item of export and the minimum percentage is put up on the table here. And again, it's with reference to gold and silver and platinum. So in case if I am exporting any plain jewelry, articles and ornaments like Mangal Sutra, which contains gold, black beads, imitation stones, except in the studded form, so I have to achieve a minimum 3.5% value addition. In case of studded jewelry and articles, it is 6% in case of studding with colored gemstones and 7% in case of studding with diamonds. In respect of mountings and findings which are manufactured by mechanized process, the value addition that needs to be achieved is 2.5%. And in case of medallion and coins, which is excluding legal tender, of course, that is 1.5%. And any jewelry which is manufactured using fully mechanized process, the value addition that I need to achieve is 2%. So this gives an overview of the Advanced Authorization scheme. I now come to the ROTEP scheme, which is there. So before we go on to ROTEP, it's just important to understand some important timelines. Like on the 4th March 2020, it was announced that the ROTEP scheme would come. This would be a more WTO compliant scheme that seeks to reimburse the exporters with all the embedded duties and taxes which are incurred by them in relation to export goods and where there is no other compensation available. And this scheme was approved on March 2020. On 1st Jan 2021, this scheme was implemented and MEIS was discontinued. So 31st Jan 2020 was the last day for MEIS and ROTEP had come in place in that case. But the rates were notified only in August 2021. So the ROTEP rates and guidelines were notified in August, although the scheme was operational from Jan. So there could be some transitional issues in respect of the exports or consignments that took place between Jan to August. So now coming to what exactly is ROTEP. So as I mentioned, it's a remission-based scheme, which is looking to reimburse for all the embedded or hidden costs when I'm exporting a certain product that is getting reimbursed under the scheme. So this is available to all exporters of notified products, but there are some restrictions. So the exporter needs to create an account with customs in order to be able to claim this benefit, because this is a fully digital and not involving any human interface. This account creation is imperative. And the benefit in ROTEP will be given in the form of duty scrips and would be calculated as a percentage of the FOB value of the exports. So coming to what are the embedded taxes. So these are typically the Mandi tax. Then there is central and state taxes on fuel. Currently, petroleum and fuel is not subsumed under GST. So the central and state levies on that are not getting reimbursed under any other scheme. Then there's electricity duty in some states, which may be applicable. And then toll tax and stamp duty on import-export documentation. And then there is embedded CGST and SGST on purchases from unregistered dealers. So all these are subsumed under ROTEP. However, I would like to mention that ordinarily, if I'm getting GST from any regular supplier who is not an unregistered person, that is not covered under ROTEP because that would be covered under the normal input tax or refund mechanism, which is there prescribed under the GST law. So while ROTEP is more or less available for all kinds of exports, but there are some restrictions where we cannot claim any benefit of ROTEP. So exports which are originating in a third country, but transshipped through India. So for example, if any export has originated in a country, say UAE or Hong Kong, but they are reaching India, and from India, they are intended for export to another place, like say, for example, Singapore. So these kind of exports will not be eligible for ROTEP because they are only being transshipped and there is no value addition being done in India for them. Then there are deemed exports, which are there. Those are also not covered in this scheme. Then the supply of products which are manufactured by DTA units and supplied to an SEZ, they cannot claim the benefit of ROTEP. Even notwithstanding the fact that the SEZ is exporting the products, still this benefit cannot be claimed under ROTEP. With products which are manufactured in a warehouse or a bonded warehouse in customs, those are not allowed because when we are importing such products, there's no duty being paid. So therefore, when the export takes place directly from the custom bonded warehouse, then no such benefit of RoDTEP can be claimed. Any products which are manufactured or exported in discharge of an export obligation under the Advanced Authorization scheme, which we just discussed, so those are not covered. So if I'm taking benefit of Advanced Authorization, I will not get any benefit of RoDTEP. And then there are exports by 100% export-oriented unit, which is located in free trade zones, export processing zones, or special economic zones. So those are not covered under this scheme. And one other important thing is that exports for which the IceGate EDI documentation is not generated is not covered. As I said, that this is a fully automatic and IT-driven scheme. So if you have not generated the documentation or the shipping bill using EDI, which is electronic data interchange, then this benefit would not be available. So now coming to what are the rates for RoDTEP. So the rates are specified in Appendix 4R of the Foreign Trade Policy. And along with that, there's a notification issued. So the percentage of rebate which is applicable to majority of the products under the gems and jewelry sector is as follows. So in respect of natural diamonds, lab-grown diamonds, and jewelry of these precious metals, the rate is 0.01% of the FOB value. So in other terms, for every rupees 10,000 which is exported, 1 rupee would be given as a rebate under the RoDTEP scheme. And in respect of jewelry which is studded with imitation pearls or imitation or synthetic stones, the rate is 0.5%. So what's the roadmap to avail the benefits is that one is that you have to declare your intention of availing the benefit of RoDTEP scheme on the shipping bill or your bill of export. You need to create the electronic ledger account on IceGate portal. Then there has to be readiness with regard to some documentation that needs to be maintained with regard to this. And before the export takes place, whether you will get the benefit or not, that has to be evaluated by using help of your CHA or other consultant. So I'll just cover some other aspects of the RoDTEP scheme, which are there. Like it's a remission-based model, which I have already mentioned, that it is only for the embedded taxes on which no other benefits are available. So even the taxes which are covered, but if I'm getting a benefit under any other law, then I will not be eligible for RoDTEP on that. GST is not covered on this. Whether it's on domestic or imports, you will not get the benefit of GST on this. There is no, the claim process is quite simple. Like it just on the export or shipping bill, one has to indicate whether they want to claim the benefit of the RoDTEP, and this shipping bill which you filed, either taking RoDTEP Y or RoDTEP N, meaning yes or no, that will be deemed to be the application for the claim of RoDTEP. And RoDTEP benefits will be in the form of scripts, and these scripts, in our understanding, can be used for payment of basic customs duty. So far, it's not clear whether this can be used for dumping duty or other things. Certainly, it cannot be used for GST. So it cannot be used for the IGST and compensation cess on imports, but it can be used for basic customs duty. And all the export incentives are subject to realization of sales proceeds within the time limit, which is given by RBI. The exporter also needs to maintain the RoDTEP ledger, and the benefit will be directly credited to your ledger. That's how it's going to be paid. Now I'm coming to another important concept, which is of export-oriented units, which is also something which is quite popular in some of the gem and jewelry players. So firstly, what's an export-oriented unit? So an export-oriented unit is a unit which undertakes to export their entire production of goods and services. So one important thing that needs to be understood is that EOU benefit is available for goods as well as services. And the intention is that it should be 100% for exports, except there are some permissions given for DTA sales. But it is by and large to be done for exports. Okay, and for the gems and jewelry, the manufacturers or persons who can avail this benefit can also undertake repair, remaking, reconditioning, re-engineering, and even some services if they want to provide to their overseas entities. That can be done using an EOU. However, traders are not covered under the EOU model. So I cannot import or domestically buy and sell the same product. That's not allowed as per the EOU norms. So why EOU taking this compliance or this incentive is beneficial is that it gives you a benefit of procuring the raw materials and capital goods duty free. And it is available irrespective of whether you import or obtain this indigenously. So even if I'm obtaining this within India, I can get the benefit of procuring certain raw materials and capital goods duty free. And there are also some benefits under GST law for EOUs. Like EOUs are considered as a deemed export under the GST laws. So there are certain benefits attached to that as well. Then gem and jewelry export oriented unit. So there are specific provisions in the foreign trade policy, which are specific to the gems and jewelry sector. That is there. So jewelry exports are permitted based on a notional rate, which is issued by a nominated agency. That's allowed. Then G&J EOUs can also re-export as well as export manufactured goods, including for repairs or remaking of jewelry. Then supply of unsuitable, broken, cut and polished diamonds, precious and semi-precious stones to DTA is also allowed up to 5% of the value of the goods procured without meeting the foreign exchange criteria. And this can be done against a valid REP and on payment of duties, including the GST. Then subcontracting through other EOUs, SEZs or units in DTA is also permitted, subject to certain conditions. For cut and polished diamonds, precious and semi-precious stones, however, like I'm talking only about the cut and polished ones, there the subcontracting is not permitted if you're availing a benefit of EOU. They have also given specific provisions for exhibitions and trade displays, and there are some exemptions which are given to export-oriented units for that. The terms and conditions are quite detailed. So in case of any specific question, we'll be happy to connect with you for that later. So just to summarize some of the important aspects of EOUs. So for EOU, an application needs to be made to the units grant committee. There's a units approval committee which will give you a permission to register your premises as an EOU. And on approval, a letter of permission or an intent will be given by the authority. So it is only a myth that EOU needs to be located in a particular zone. It's not like that. Any unit can take this benefit, but they just have to comply with all the conditions to meet and obtain a letter of permission or intent. Then EOUs need not pay the duties of customs, including IGST and compensation cess on goods and capital goods and excise duty. So here you also get the benefit of not paying the GST in case of imports, and on certain local procurements also there is a benefit of refund. Like if a local person is supplying to an EOU, he can get either he can claim refund or the EOU unit can claim refund. Then there is a minimum investment criteria, but for being an EOU, the minimum investment that you need to make in plant and machinery is rupees 1 crore. This limit is lower for handmade jewelry. But we have to have a capex of 1 crore if we want to take benefit of this. Then EOU have a requirement to export 100% of their output. In an ideal situation, the EOU has to do 100% export. Nothing should be sold within the landmass of India or the DTA. But there are some conditions for which the EOUs can sell to the DTA, which are there. But this is subject to conditions prescribed by DGFT. In our understanding, up to 10% of the FOB value of exports can be sold by a G&J EOU to a DTA. The EOU benefit also requires you to achieve a specific value addition. The value addition is same as what I mentioned in advanced authorization. So that needs to be achieved. And in addition to that, an EOU should have net foreign exchange earnings, which are more than zero, which are positive. That is, your exports have to be greater than the CIF value of the imports. The only thing or a catch, like why EOUs seem attractive but many don't opt for it, is that it requires maintaining certain specific books of accounts, and you also need to file a quarterly and annual performance report with the agency which has granted you the approval to act as an EOU. So that's why it's sometimes not pursued because of the documentation and the compliance requirements. For the drawback and other schemes, I would request my colleague, Mr. Ritesh Negandhi, to take you through them. Over to you, Ritesh.
Yeah, thanks, Siddharth. Yeah.
सर एक इम्पोर्टेंट चीज कहना चाहूंगा जो मेंबर्स यहाँ पे जुड़े हैं कि आपके जो भी क्वेश्चंस होंगे आप प्लीज उसको Q&A में पोस्ट करते जाइए जिससे कि कार्यक्रम के अंत में जो हमारे स्पीकर्स हैं उसका आपको जवाब दे सके। तो Q&A में आप अपने क्वेश्चंस पोस्ट कर सकते हैं। थैंक यू सो मच सर, आप कंटिन्यू करिए।
Yeah, so thanks, Siddharth. So if we see the term duty drawback, the term itself suggests that it's drawing duty, custom duty which is already paid, and we are drawing it back. So government will be giving the custom duty which is already paid. So duty must be paid first and then drawing back. So let's now go to the definition of duty drawback. So duty drawback is a type of export incentive where the duty is paid on imported material or other inputs used in either manufacturing or processing or carrying out any operations on the goods that are exported outside India is allowed as a refund to the exporter. Here the duty must be paid first on the imported goods and it must be either used in manufacturing, processing or carrying out any operations on the goods that are exported out of India. And the refund is pertaining to that. So there are two kinds of duty drawback. That is under section 74 basically, which says that duty drawback is allowable on re-export of duty paid good. So re-export of duty paid good means that the import duty, custom duties must be paid on the good first and the same goods must be exported back. It should be the same goods which are imported earlier that must be exported over here. And also there is a section 75 which deals with drawback on material used in the manufacture of exported goods. So inputs must be used in the manufacture of exported goods. So drawback is pertaining to section 74 and section 75. So if you see the nature of incentive, the drawback shall be paid to the exporter or to the agent specifically authorized by the exporter. So it can be either be paid to the exporter or to its agent who is an authorized for the on behalf of the exporter basically. And drawback can also be paid by way of check or by credit in the exporter account maintained by the custom house. Yeah, can we move to the next slide? Yeah, now other important aspects of duty drawback is there has to be an order for exportation by the proper officer required. If one is just submitting a claim for duty drawback, I mean, just the documents are submitted to the concerned officer, the appropriate officer for duty drawback, that cannot be concerned as a you have submitted a claim for duty drawback. There has to be a proper order for exportation. Once there is a proper order for exportation for the goods, then only the duty drawback claim gets activated. Also, drawback is eligible only for imported goods where duty of customs has to be paid. So this is also an important aspect. The duty of custom needs to be paid first. So in case any goods are imported under any duty credit scheme like road type scheme or an advanced authorization scheme, there in case imports do not suffer any custom duty, then drawback is not allowable. If we see the maximum amount of duty drawback, that is 98% if the goods are re-exported without being put to use in India. So 98% drawback is the highest drawback which is eligible in case the goods which are re-exported without being put to use in India. Now, for used goods, the drawback would be allowed at notified rates. So government has given the notified rates where in case any goods are used and there is a time gap between import and export. So drawback goes on reducing. So we shall see that in the next slide. Now, also goods should be capable of identification to the satisfaction of proper officer. So here the drawback is allowable under section 74. The good needs to be identified and it must be capable of identification to the proper officer. It should be the same goods which are imported earlier. The same needs to be re-exported back again. So your import documents and your export document needs to be correlated to establish the fact that it is the same goods which are imported earlier are again re-exported. Under duty drawback under section 74, there is no requirement of minimum value addition. If you see under section 75, there is a requirement of minimum value addition. But under section 74, there is no requirement. The good needs to be exported as is basis basically. goods must be re-exported within 2 years from the date of payment. So this is the maximum period. It must be re-exported back within a period of 2 years from the date of payment of duty. There is no requirement to bring any export proceed in convertible currency. Under the duty drawback under section 74, there is no requirement to get convertible foreign currency, and the convertible foreign currency rule is not applicable here over here. Now let's go to the time frame, the length of period between which the date of clearance for home consumption and the date when goods are placed under custom control for export. So if depending upon the time frame, the drawback grows, percentage of drawback goes on reducing. If you see over here, I mean, if the goods are exported within a period of 3 months, then 95% of the drawback is eligible. If the goods are exported within a period of 3 to 6 months, then 85% of the drawback is eligible. Between a period of 6 to 9 months, there is again 75% of drawback eligible. Between 9 to 12 months, 70% of drawback is eligible. Then if you see 12 to 15 months, 65% of drawback is eligible. Then 15 to 18 months, 60% of drawback is eligible. And if you see beyond a period of 18 months, if goods are exported, there is no duty drawback. So if you see the drawback percentage goes on reducing depending upon the time frame. I mean, the time frame between import of goods and re-export of the goods is very important. So drawback varies depending upon this time frame. Yeah. So let's see other salient features of duty drawback. If you see the assessable value for drawback. So drawback under section 74 is based upon the duty, tax, cess referred in the Custom Tariff Act and paid on import. And IGST and GST compensation cess paid on imports is also eligible for duty drawback. So the main point over here under section 74 is IGST and GST compensation cess, which is paid on imports, is also eligible as drawback. If you see, compare it to section 75, then there IGST and GST compensation cess is not eligible. But over here and at section 74, it is eligible. Order for export, if we see, the goods imported must have been entered for export either way of shipping bill of export or as a baggage or by post. If you see the claim process, the claim for drawback needs to be filed within a period of 3 months from the date of export order. The custom officer may also extend this period in case an application is made and valid reason being provided. So basically here the shipping bill or the bill of export, the declaration needs to be made for the drawback claim. That basically the declaration is pertaining to the payment of duties and regarding it is pertaining to the payment of duties on import and regarding the usage of goods. So declaration needs to be made on the shipping bill. So only a tick needs to be made on the shipping bill that you need to provide me the duty drawback claim, and the intent on the shipping bill needs to be there for providing the claim. Now payment and interest. The drawback would be paid either in cash or in credit to the exporter account. Or drawback is payable within 1 month of filing, and in case the government is not providing the duty drawback claim within a period of 1 month, there is appropriate interest being provided by the government on the drawback claim, that is 6%. Now we come to drawback under section 75 basically. So under section 75, if you see the duty drawback is in relation to any goods which are manufactured in India and exported, means the rebate of duty excluding IGST and compensation cess, which is leviable under section 37 and 39 of Customs Tariff Act and chargeable to any imported material or excisable material used in export of such goods. So inputs must be used in manufacturer and the finished product must be exported. Also, the drawback rules, the export means taking place from a DTA, that is a domestic tariff area, to a special economic zone. So that is also considered as an export and duty drawback is eligible on it. So now the taxes which are not covered under duty drawback are basically IGST, which is payable in respect of importation of goods, and compensation cess, which is payable in respect of import of certain goods. As compared to section 74, Even IGST payable on importation of goods is eligible as drawback and compensation cess. But over here in section 75, both are ineligible. If you see the relevance for gems and jewelry industry, drawback available on imported articles of jewelry made of gold, that is rupees 372.90 per gram of net gold content in the jewelry, and silver, that is rupees 4,332 per kg of net silver content in the jewelry. And the purity of the gold needs to be 0.995 or more, and that of silver needs to be 0.999. If drawback is permitted, it would lower the cascading effect of taxes and bring down the cost of production. That is the intent of the government. That is, export need not suffer tax. Thus, a drawback claim is provided by the government as an incentive and as a refund to the exporters, so they can validly claim the export benefits on a timely basis. Now, drawback used in the manufacture of export goods. So drawback is available for goods which are notified by central government. So the drawback rates are basically, government comes out with a drawback rate on a timely basis, and it is only pertaining to goods notified by the central government. So there are almost around more than 2,000 goods on which the drawback rate has been decided by the government. And drawback is rebate of duty excluding IGST and the compensation cess. So drawback is also paid in cash or in exporters creditors custom account, and drawback is calculated at the notified rate. So there is an all industry duty drawback rate which has been notified by the government, and based upon which drawback claims can be made. See, in case of goods is not falling under, if an SEC's goods is not falling within the all industry duty drawback rate schedule, then he may apply for a brand rate basically. Then the government can establish the duty drawback percentage in respect of that goods. And in case one feels that all industry duty drawback rate is less as compared to the custom duty which has been paid on the goods, then he may apply for a special brand rate. So that is the difference between a brand rate and a special brand rate. So also good needs to be manufactured for the imported product. So good needs to be manufactured from the goods which are imported, and the finished product needs to be exported. There is certain amount of value addition which is required for drawback eligibility over here. Also, order permitting export clearance is required and sufficient for making drawback claim. In this, under section 75, the convertible foreign exchange needs to be realized within the time limit of FEMA. That is 9 months, which can be extendable by RBI in case an application is made. So, yeah. You can go other aspects of the drawback under section 75. Now, situation in which drawback claims can be denied in case any good is manufactured partly or wholly in a custom bonded warehouse. In case a product is exported in discharge of advance authorization or a duty exemption scheme. Export by an 100% EOU unit. Export by a unit located in a free trade zone, export processing zone, or a special economic zone. If we see all these four, here the imports are taking place without payment of any custom duties. So the government is not allowing drawback pertaining to the same, because there cannot be a double benefit. So to avoid the double benefit, government is not allowing duty drawback in these cases where the goods at the time of import have now suffered any custom duties. Also, market value of good export is lower than the drawback amount. Also, market value of export is lower than the value of good imported. You see the maximum amount of duty drawback, it should not exceed 1/3 of the market price of the export products. Now, how to claim a duty drawback? If you see the electronic shipping bill in the EDI under the claim of drawback shall be deemed to be the claim for drawback. So just one need to be made a tick in case of electronic mode shipping bill will itself be a claim for duty drawback. And in case of manual filing, the exporter may file triplicate copy of shipping bill, that is under manual filing, for export under claim of drawback, and that would be the date of custom officer make an order permitting the clearance for export of the goods. We can move to the next scheme, that is export promotion of capital goods, that is the EPCG scheme. Now let's see the objective of this scheme, so that any machinery on any capital goods basically imported, and there is an export obligation attached to this scheme. So any machinery and capital goods which is imported first and the goods needs to be manufactured out of that capital goods or machinery, and then same needs to be exported. That is the intent of this EPCG scheme. So government is allowing import of capital goods without any payment of duty in case it is being manufactured, goods are manufactured out of that capital goods and exported back. If you see the definition of capital goods, it is a very wide definition. I mean, it is covering everything. Capital good means any plant, machinery, equipment, or accessories which is associated to that plant and machinery required for manufacture or production, either directly or indirectly, of goods or for rendering services, including those required for replacement, modernization, technological upgradation, or expansion. So all the specific possibilities have been covered under this definition. It also includes packing machinery and equipment, refrigeration equipment, power generating sets, machine tools, equipment and instrument for testing, research and development, quality and pollution control. So it is covering all kinds of capital goods in this definition. Now, what the definition under EPCG is covering, capital goods as we just discussed, then computer systems and software, which are part of capital goods being imported. So even software is part of capital goods, which is being whatever be considered as a capital goods. Spares, molds, dies, jigs, fixtures, tools and refractories, and catalysts for initial charge plus one subsequent charge is covered under the definition of capital goods. Now let's see the coverage of EPCG. Basically, if you see the coverage, this is based on the actual user condition. So as we see the road tap scheme or an SEI scheme where the duty credit schemes are transferable, I mean, which can be sold in open market. This EPCG scheme is based upon the actual user condition, and the person who is importing the capital goods only needs to use that goods, or it's in this case, the supporting manufacturer can use it. So if you see the coverage and the manufacturer, exporter with or without the supporting manufacturer. So the person who is manufacturing the goods, finished goods, he can import the capital goods without payment of custom duties, or the supporting manufacturer is also allowed. So in case he can also provide the job working facility to the supporting manufacturer, and he can also be clubbed under the EPCG license. Merchant exporter, that is traders, tied to the supporting manufacturer are also covered under the EPCG scheme. The name of the supporting manufacturer to be endorsed on the EPCG authorization before installation of capital goods in the factory, that is premises of the supporting manufacturer. So chartered engineer certificate needs to be provided in case of machinery installation, in case it is being installed at a supporting manufacturer premises over here. Also service providers, including those designated as common service provider by DGFT. So in case capital goods are being imported for providing services, then those are also service providers also covered for importing of capital goods over here. If we see the export obligation, imports under EPCG subject to export obligation equal to 6 times of duty, taxes and cess saved on capital goods. So the export obligation needs to be fulfilled at 6 times the duty, taxes and cess saved on capital goods. Basically, the export obligation has to be fulfilled within a period of 6 years from the date of authorization. This period of 6 years can be further extended provided there is a permission, and also in case one is not able to fulfill an export obligation, then there are heavy penalties which are being imposed by the government in this case. Now the authorization shall be valid for a period of 18 months from the date of issue. The export obligation to be fulfilled through export of goods manufactured by him or his supporting manufacturer, services rendered by him for which authorization is obtained. In case of direct export, export obligation shall be reckoned with reference to actual duty saved amount. In case of domestic sourcing, export obligation shall be reckoned with reference to notional duty saved on freight on road basis. Now, there is other export aspects also pertaining to EPCG scheme. There is another scheme also, which is post-export EPCG duty credit scheme, where the payment of duties needs to be made first at the time of import of capital goods and taxes, and those can opt for this scheme basically. And basic custom duty paid on import capital goods shall be remitted in the form of transferable duty credit spreads. Now we move on to the special economic zones, that is the SEZ. Now, what is in SEZ basically? If you compare it with EOU, basically, EOU is basically an export-oriented unit which can be set up anywhere. An office also can be converted into EOU. The premises can be demarcated and it can be converted into EOU. But an SEZ, it is a designated duty-free jewelry manufacturing zone. Basically, the government have established SEZs in 9 locations all over India, and over there, the manufacturing can take place. So as compared to EOU, where EOUs can be set up anywhere, even an office can be converted, SEZ is a manufacturing zone which is established by the government. SEZ in India enjoys exemption from customs as well as GST laws and have all the facilities, including custom clearance for fast track export. So SEZ in India has all the exemptions from customs, GST purpose. So if from one is exporting goods from a DTA to an SEZ, also there is no duty applicable. So supplies from DTA to SEZ are eligible for 0 rating, that is export. And such supplier may apply for refund of GST paid, or alternative, he may supply to SEZ on letter of undertaking, that is the LUT, and take refund of accumulated input tax credit. Now, as we discussed, in gems and jewelry specific economic zone, there are located at 9 locations, that is Sibsej, Andheri, then it has in Surat, which is a special economic zone in Gujarat, and at Uttar Pradesh. As if you compare it with EOU, if one is supplying goods from DTA to an EOU, then GST is applicable. But in this case, in case of special economic zone, if one is supplying goods from DTA to an SEZ, then they are considered as 0 rate. So that is also one of the important reasons pertaining to comparison between EOU and SEZ. So let's go to an update on the various schemes. So Advanced Authorization scheme, the government has extended its validity up to 31st March 2022. If we see the EPCG scheme, it has been extended also to 31st March. But in the recent budget, the FM has indicated that this scheme of EPCG may be discontinued going further and custom duty may be applicable. If you see MEI scheme, this is discontinued already from 1st of January and being replaced by a road tax scheme. If you see the drawback under Section 74, so presently government has not come out with anything pertaining to discontinuation of the scheme, and this shall continue. If you see EOUs, it is up to 31st March 22, and special economic zone depend upon the state specific policy. Although in the budget speech, the FM has indicated that a new legislation would be provided pertaining to the administration of the special economic zone. Thank you.
Thank you, Ritesh ji. थैंक यू रितेश जी। सिद्धार्थ जी, अब हम Q&A के लिए जाएंगे, क्योंकि आपके सामने पोर्टल में दिखाई पड़ रहा होगा जिस तरह से क्वेश्चंस हमारे पास में आए हैं। कुछ Q&A में क्वेश्चंस आए हैं, कुछ चैट बॉक्स में आए हैं। तो हम समझते हैं Q&A से हम स्टार्ट करते हैं, उसके बाद में हम चैट बॉक्स में जाएंगे और जो भी क्वेश्चंस है उसका एक एक करके आंसर देने का हम प्रयास करेंगे। तो Q&A में सर जो पहला क्वेश्चंस है आपके सामने, आपको मुझे लगता है सर दिखाई पड़ रहा होगा।
Yes, sure.
So
the first question that we have is that ROTEP scheme for plain and studded gold jewelry, that one is not able to take the benefit because the nominated agencies don't give refund of duty and GST if we are opting for ROTEP. So one cannot take double benefits. So that is correct, because if we are getting the benefit of duty-free procurement from the nominated agencies, then one cannot take simultaneous benefit of the ROTEP. The intention is that it has to be totally something which is not covered or any hidden duty. Only those are covered by ROTEP. That understanding is correct. Then one of the querist has a requirement to throw light on the order for exportation. by proper officer. So requesting if Ritesh can just explain the order for export.
Yeah. So order for exportation means you need to submit proper documents related in relation to the goods which are being exported. And once he is satisfied that the documents are proper and eligible, considering the value addition and any other details, then he will issue a order for exportation. So that is basically the order for exportation. Once the order for exportation is issued, then suppose if one is claiming a duty drawback, he becomes eligible for a duty drawback.
Right. The next question is pertaining to drawback. So the question that is being asked is that whether drawback and refund are similar. So Ritesh, requesting you to take this again.
Yeah. So basically drawback is a kind of incentive in the form of a refund. Basically, it's a kind of a refund, you can say, or a rebate of the duties which are already being paid.
Yeah, so the answer would be that, yeah, it is actually the same thing, but only thing is that because the duty has already been paid, it is in the nature of a drawback.
Correct.
Okay, so the other querist is located in an SEZ unit. Their question is that if we purchase gold from vendor from local market and he is importing the gold bar by paying custom duty, in this case, can we apply for duty drawback? In my understanding, this would not be permitted because that person who has imported it, unless he has been tied to you as a supporting manufacturer, then only the benefit can be extended. Otherwise, it cannot be extended. So what would be advisable is that if they are your manufacturer and if you're doing bulk orders with them, when you're obtaining the authorization or other aspects, then that could be taken up by them. But if you're located in an SEZ, then this benefit is not available because if they're supplying from a DTA to an SEZ, but they have procured it with payment of duty, then this benefit is not available. So that would be my understanding. The only way one can, look at the duty saving is only if that DTA supplier takes the benefit of being a holder of advance authorization. Otherwise, it's not available. It becomes a cost. Okay. So, there was just one question on the GST rate for the metals which are used in, what I understand is it's for the metals which are used in the production of the jewelry, and what is the output rate on the jewelry. So requesting if Ritesh can take that.
Yeah, basically one needs to understand what are the raw material which are being used over here, based upon which the rates can be looked into. Basically, you can provide us a specific raw material which what kind of diamonds are being used for making jewelry or product, then we can you can mail us the details and we can reply over an email basically over here.
Yeah. So one question has come is that currently the drawback available on silver, which is prescribed at a certain amount per kg, is very low because the price of silver is very high and it's not neutralizing the whole effect of the duty while exporting the silver jewelry. So I understand the question is that is there any relief mechanism under drawback which can be claimed for this? So Ritesh, would you?
Yeah, one can, in this case, if one is feeling that a drawback of silver is low, then considering one specific product, one can apply for a special brand rate of duty drawback, and he can then the officer would analyze the said documents and also the situation and the transaction, the nature of transaction and the goods involved, and he may then the drawback rate may be decided by him based upon the documents and the nature of transaction over here.
Okay. The next question is, can we claim for interest if we are not getting the duty within 1 month of filing? So the time limit for 1 month is specific to drawback again. And my understanding is that if the amount is not sanctioned, then automatically it comes with interest. And if interest is not there, we can make a claim for the interest amount as well. So that would be my understanding for it. I think that covers all the questions that we have.
थोड़े से क्वेश्चन सिद्धार्थ जी हैं कि लोगों ने पहले से पूछ रखे थे, तो हम चाहेंगे कि उसको भी एक एक करके हम देख लें और जो पहले से क्वेश्चंस आए हैं उसके भी हम आंसर दे सके आपके माध्यम से। एक सेकंड, आप देखिए ड्यूटी ड्रॉबैक बीन मोर देन 6 months since export and payment realization under the duty drawback scheme, but haven't is seen a rupee or drawback yet, तो कंप्लेन है आपका उस क्वेश्चन नहीं, क्योंकि वो तो आपको वही से क्वेरी करना पड़ेगा जहां तक मैं समझता हूँ सिद्धार्थ जी। तो अगर आप क्वेश्चंस को देख पाए हो तो आप उसके बारे में करना चाहिए।
I could see one question in the chat box, that is the export order the same as the let export order? Yeah, it is the same thing, but it in some cases instead of a shipping bill, because if you're re-exporting something without commercial value, then it will take the form of an export. It will not be in the form of a shipping bill, but it will be in the form of an order for export. So it is the same concept. The shipping bill is included in the order for export. So it's a wider concept. One other question that we have is, where can we check the drawback rates which are applicable on export of precious metal? So, Ritesh, could you guide on that?
Yeah, there are notifications being issued on timely basis. So one needs to go through the customs regulation, the customs tariff act, for checking the drawback rates.
मैं इसमें ऐड करना चाहूंगा मेंबर्स के लिए कि DJPC की वेबसाइट पे भी जो नोटिफिकेशंस आते हैं उसको अपलोड करते हैं। आप ड्यूटी ड्रॉबैक्स के भी रेट्स वहां पे जाकर के देख सकते हैं। हमारे ऑफिसर्स ने आपको पहले पोस्टिंग किया हुआ है यहाँ पर 17/7/2020 को जो है सर्कुलर जो आया हुआ है वो हमारी वेबसाइट पे अवेलेबल है। आप करेक्ट के लिए आप वहां जाकर के देख सकते हैं।
Yeah, one more question in the chat box is that, is it allowed to import gold under 0.999 purity under Advanced Authorization? So as such, specifically because of Advanced Authorization, there is no restriction on what kind of gold is imported. However, on the export side, there is a restriction on the Advanced Authorization, like the gold jewelry, which is including partly processed jewelry and articles including medallions and gold, which are whether they are plain or studded, but they have to contain gold between 8 carats and above, up to a maximum of 22 carats. So there is a restriction in the scheme on specifically on Advanced Authorization on the export side, which is as per the scheme on the website, but there is no restriction as such on the import. But what I understand is that gold beyond 99.9% purity, there are some restrictions under customs. But we can specifically check and let you know about that restriction. But as far as Advanced Authorization is concerned, there is a specific restriction on the export, that it cannot be, it has to be between 8 to 22 carats. That is clear. And in case if we are using any mountings, that will be between 3 to 24 carats. So that's what is that.
सर एक क्वेश्चन और था जो कि आप आपके समझ लाना चाहेंगे। ड्यूटी ड्रॉबैक के लिए था, इट इज अवेलेबल एट स्पेसिफिक कस्टम लोकेशंस ओनली। क्यूएनए में आप देखें लास्ट क्वेश्चन, एक और क्वेश्चन आया हुआ है
हाँ जी
ड्यूटी ड्रॉबैक के बारे में।
Duty drawback, the question is that, is it available at specific customs locations only? Like AFIAK or SHB customs rate does not accept duty drawback. In my understanding, it should not be linked to the place from where you're importing. The duty drawback would be available. Only condition is that the export has to take place within the time limit which is given, and an export order has to be obtained. There's no restriction as far as the place of import is concerned. That is what my understanding would be.
थैंक यू सो मच सिद्धार्थ जी। और जो ऑडियंस में हमारे जो मेंबर जुड़े थे, आपके और भी कोई क्वेरी होंगे तो आप निश्चित तौर पे हमें मेल करिए,
Thank you everyone.
Thanks everyone.
जल्दी